View Day 12. This will be our discussions involving goals and governance of the corporation. And our source is from Fundamentals of Corporate Finance by Preely, Myers, and Marcus, 2018 edition. So to begin with, we have our topics as covered. So we will be discussing investment and financing decisions, what is a corporation, and the rest will be in the next part, the second part of this particular series or video. Let's begin. First is investment and financing decisions. This particular sort of terms and words actually are discussed exhaustively in financial management courses. So if you are done with such, I'm pretty sure that you can very well connect to these discussions, especially for investment, wherein that is basically placing, or that is an account that is created when we put or place our monies to certain vehicles or financial instruments that would generate returns in the form of interests for debt, for example, investments, and for dividends if equity instruments plus the increase of the value, capital gains. So basically those are tackled in financial management courses. And financing is when the company represented by the management, normally this is corporate finance, so the corporation would be represented by the managers who will be deciding if ever the company is gonna increase the number of shares or issue more shares. That's the equity financing, or the debt financing, issue bonds or borrow money from banks, for example, and other financial institutions. And one area, specific area for that is basically capital budgeting. Capital budgeting is also discussed exhaustively in this channel. You can also check that out. So in capital budgeting, that is going to involve a decision to invest in tangible or intangible assets. Tangibles specifically are assets that can be perceived by our senses, that can be touched or can be seen literally and figuratively, while intangible assets are the opposite. We can also say tangible are having the physical substance, while intangible are not. So those are also discussed in accounting courses. Capital budgeting is also known as investment decision, if we attach that word, or the CapEx decision, capital expenditure. Now, a review of this one from our intermediate accounting, that if we say capital expenditure, it means an expenditure that would benefit more than one accounting period. So example, if we are going to, for example, just to connect this with PPE, wherein, if I say PPE, I mean property, plant, and equipment. For example, let's say a certain platform or a certain life-saving platform is being installed on the machinery in order for the company to protect the employees. Based on the experience of the company, that because of this life-saving platform, it is expected to reduce its payouts and payments to certain employees who are actually affected, or let's say damaged by such accidents because of failure to have the life-saving platforms of the machineries. So such things, which can be translated in financial terms, like 20% net already of the reduction of the cost, or let's just say because of that particular life-saving platform, so 80% reduction of the payouts of the respective damaged or affected employees. So those things can also be taken into consideration. Just to have a review, the opposite of CapEx, by the way, is revenue expenditure, wherein that is an expenditure that the company will be benefited in a short-term period. which is 1 year or less. That's our point of view in accounting. Then in capital budgeting, we have again two assets, and one example of the investment or the investment decision involving tangible assets is when, let's say, our company is Southwest Airlines and it purchased new planes. So basically, where's the asset here? The new planes, and these are tangible. On another hand, we have the intangible assets. So for example, GlaxoSmithKline, what a company name, R&D expenditures. R&D stands for research and development. So this particular part here, though, we have to go back to our IAS 38 intangible assets. We have to pay homage to that, wherein we can actually capitalize the cost of R&D expenditures if ever there is already the establishment of technical feasibility up to such time that is prior to commercial production of the prototypes, or simply when the company is now being able to make the prototypes. That's the point of stopping the capitalization, or to capitalize. If we say capitalize in financial accounting and reporting and business, meaning to say we are going to add to the cost of a certain asset or a certain expenditure to the cost of the asset. Financing decision, on the other hand, as what we've said, will be the decision on the sources and amounts of financing. And we can do this either by debt or equity. For debt, we can have the financial obligations in the form of long-term debt, and then we can also have the shares for the equity. Examples again of long-term debt would be our bonds payable, issuance of funds. So the company would be sourcing funds by issuing those debt instruments, and then that's an obligation of the corporation to certain investors. Investors will be getting interest out of that. As for us, we'll be paying debt, and then the principal plus the interest. For equity financing, as being explained a while ago, the company will issue shares, and then the company will be, of course, issuing shares, and the investors will become shareholders of the corporation. The shareholders will be getting the dividends and capital gains, in which the gains are basically the increases of value of the shares. So we focus on the gains, although losses can happen, but our target is that dividends plus the capital gains. In investment decision, in which you would like to have those returns, so that's why we focus on the assets. So we are on the left side of the accounting equation. Accounting equation, or basic accounting equation, is assets equal liabilities plus equity, while financing is focused on the firm's debt and equity. All right, so moving on. For the assets, they can be real or financial. Real would be assets that are used to produce goods and services. So we can say, for example, our property, plant, and equipment items, like the building, the land, furniture and fixtures, machinery, land improvements, building improvements, and those items that are used to produce goods and services. Now, basically, the key term here is production. On the other hand, financial assets are financial claims to the income generated by the firm's real assets. If we use the real assets in the operations, and then the goods and services are produced, goods are being delivered to the clients, and customers and services are rendered to the company, will have income. Now, the claims to the income will be the financial assets. It can be in the form, or they can be in the form of direct cash, because it's made on cash, or cash equivalent can also be paid, and then even receivables can also be paid. So whether short-term or long-term, and these are the financial assets. The company normally will be receiving something in the contract. So it could be just the principal plus the interest. So it can also be just the principal, especially for short-term receivables. More discussions of such in financial accounting and reporting. Now, here are our questions that we can ask ourselves with. So we are going to pause, for example, for 30 seconds for every item. And then we are going to reveal our answers for such. All right. And we will be revealing all answers at the end of all 30 seconds. Okay, so we are going to do that. All right, so let's have letter A. So make sure to pause this video in that part. By the way, that is Intel decides to spend $7 billion to develop a new microprocessor. That's the first. For the second one, BMW borrows 350 million euros, 350 million euros, that's a symbol, from Deutsche Bank. So I will pause this now. Letter C is Royal Dutch Shell constructs a pipeline to bring natural gas onshore from a production platform in Australia. And pause. Next is Avon spends 200 million euros, there's a symbol in letter B, to launch a new range of cosmetics in the European markets. And we are to pause now. And finally, we have Pfizer issues new shares to buy a small biotech company. And let's have our 30 seconds then. And now this is our point in time that we are going to deliberate answers. For letter A, since this is an investment really to develop a new microprocessor, this is like the R&D or research and development endeavor. And of course, the company spends a lot, $7 billion for sure. There would be an output, which is a new product for this. And this is clearly capital budgeting or investing decision. So are you correct with that? You can now check respective answers on your paper. Next, for letter B, BMW borrows 350 million euros from Deutsche Bank. So no additional information. In this case, this is financing. Clearly, this is borrowing of money. Letter C is Royal Dutch Shell constructs a pipeline to bring natural gas onshore from a production platform in Australia. This is investment, construction of an asset or a PPE item. Letter D, this is also capital budgeting. By the way, C is capital budgeting. D, capital budgeting also. This is a new range of cosmetics, so a product line, 200 million euros by this. And for letter D, that's clearly an investment or capital budgeting. For letter A, there is now the part that there could be a debate because of the terms used here. So issues new shares. And our mind would be triggering that this could be financing, which is an equity financing. However, since the problem specifically states that the purpose is to buy a small biotic company, then what we can do here is, again, as you repeat, that the purpose is to buy another business. So if you are going to journalize this in a transaction, that would be a debit to investment in, let's say, the small biotic company is assuming to be a company. So investment in a company and credit the respective value of shares. So credit share capital for the par value and additional credit for share premium of excess over par. So in that case, the company receives the investment, not cash, not a source of financing. And hopefully that explains letter E. So it seems that letter B is the only financing decision. The rest, capital budgeting or investing decision. And we could be missing another term for capital budgeting. Let's look, it's CapEx, capital expenditure decision. All right. Next is a review of what corporation is. Under the Corporation Code of the Philippines, there can be some differences about the concepts if we are going to dig deeper. However, if we are going to just get the basics the same, Corporation is a business organized as a separate legal entity owned by stockholders. So its personality is clearly separate from the owners or the stockholders, also known as shareholders, since we are using International GAAP or IFRS. So we are using shares. Types of corporations could be public, in which its main operations and its purposes will be vested with public interest. Like, for example, our universities or schools, then let's say banks and our life insurance companies that are vested with public interests. Private if these corporations are not respectively available for public interest or public, let's say, fiduciary capacity, trust, and confidence. So normally all other businesses which are not public or publicly listed are considered as private. Then we have limited liability. This is in US setup. So corporations here have limited liabilities, in which in our case in the Philippines is not this given, since we actually have the limited liability concept for corporations. Herein, we are only liable as shareholders up to the extent of our capital contribution. So this is our concept actually. Then after that, we have the types of business organizations which we are very familiar with. I'm pretty sure we all know this from this particular level. One owner, sole proprietorships, two or more partners, we have the partnerships, shareholders, corporations, and we have the limited liability options for partnerships. That's actually clear under the Partnership Code of the Philippines, since partnerships could be classified as general or limited liability. For general, so at least one partner will have the unlimited liability, in that a partnership, for example, cannot pay its obligations now to the creditors, then a certain partner can be liable even beyond its investment or up to the extent or up to his separate or personal assets. While limited liability corporations are, of course, having the limited liability concept, so only up to the extent or maximum would be the investment. Professional corporations will be for the practice of profession. However, in the Philippines, so far the law specifically states that for the practice of profession, especially for CPAs, only up to the extent of partnerships. So it could be different on country and per professional competences or professional area or discipline could be. For limited liability, again, only up to the extent of investment. So separate or personal assets are not touched. Owners of a corporation are not personally liable for its, or the it there is the organization's obligations. And here is a summary. For a sole proprietorship, who owns the owners? We know this already, the manager, who is also the owner, also known as proprietor. Partnership, the partners. Corporation, the stockholders or shareholders. Are managers and owners separate? For sole proprietorship, no, the same person, there's only one owner. For partnership, it's going to be no, because normally the partners are also the managers. But for the corporation, usually that's the truth, because stockholders or shareholders will elect the, of course, board of directors, and then the board of directors would be electing the corporate officer. So basically, the managers and owners are different. Then, however, it's also true that they can be also the same, since the stockholders could be the chairman and could also be the officers of the corporation or business. And what is the owner's liability? For the first two, unlimited, but corporation limited. Then are the owner and business taxed separately? Then sole proprietorship, that's going to be no, since whatever is the sharing from the sole proprietorship, that will form part as personal income of the proprietor. But for partnerships in the Philippines, it is actually a yes, especially for business partnership, since any shares from the partnership will be treated as passive income in which that is subject to final tax. But it's going to have different ruling, I suppose, or anyway, with US. That's what we have learned. So I guess this is the point here which states here it is a no, because I've learned that for US partnerships, share of profits will be part of their personal income of the partners. But us in the Philippines, no. But for general professional partnership, well, there would be tax also on the share of the profits from the partnership. All right. So that's also one thing that we should remember of or about. For corporation, it's a yes. There's really a separation of taxes. So corporations are to be taxed separately. They're treated as another person. Since under the law, we have two types of persons, whether natural or human beings and artificial or the business. So if we talk about the two, there are two different individuals. Corporation taxed on its income, and also the shareholders who are taxed to their shares of the profits in the form of dividends. So the tax rates are discussed in income taxation. And finally, for this first part, for sole proprietorships and partnerships, we have known, of course, the unlimited liability concept, and there is personal tax on profits, no tax on the sole proprietorship level, but will be taxed on the personal level. But for partnerships, it's true unlimited liability. However, for again, as what I've said, for the partnership, there's a tax similar to corporations, and share of the profits, there's also a final tax on the partners. So it's like the corporations, except on the liability. This is taxation wise, by the way. Partnerships would have unlimited, corporations would have limited. Taxation wise, they are the same. All right. So thank you very much for listening to the first part. Hopefully you learned something from listening, and God bless.